Hi guys, it's Imran Larka from Options Insight again. Time for another market update. I haven't been on for a little while, so just thought I'd give you my thoughts and talk you through how I'm trading this market at the moment. So last video I made, I talked about this kind of short squeeze that we were expecting, and still within the theme of selling rips. That would be an opportunity to sell. Bear markets tend to have sharp bear market rallies, and I kind of think this is no different. I would say this particular short squeeze or bear market rally, whatever you want to call it, has been pretty brutal, and has lasted a bit longer than I would have thought. Helped by the fact that the Fed are literally doing everything in their power to hold the market up. I mean, the trillions of dollars that are being printed pretty much every week to kind of backstop these markets, and to the extent that they're buying junk bonds now in the US, they're literally just buying any assets that they can get their hands on in an attempt to stop this collapse. And that, to me, that does come across a bit of as an act of desperation, but the truth is, the endless money printing, they don't seem to really have any limit to it. And in that world, you could definitely see equity markets continuing to go up and almost dislocate from the real economy. So, this was the move initially. The retracement levels, the 50% retracement level has already been hit on the S&P. We haven't quite hit the final one up here at 29.32. Once we get there, maybe that could be the end of it, and then we roll over again. But the truth is, I can see a situation where the US market does dislocate. So the economy, I do expect to deteriorate further. I think job losses are going to continue, businesses are going to fail. You may even get, even though people are expecting some sort of peak infection rate in the virus over the next few weeks, let's say. You may still get second and third waves of infections come through later on in the year. And that will mean ongoing lockdowns, ongoing social distancing, and just the lasting impact of this economic shock across all industries, basically, right? It's not like everyone's suddenly going to start jumping on planes and going all over the place, because a lot of countries will still keep their borders relatively shut and only slowly allow essential travel to start going on again. You only need to look at the oil price to get a feel for how long this shock is going to last, and how long it's going to take demand to come back, right? I mean, you had OPEC agree on a production cut of roughly 10 million barrels a day, and oil had a momentary spike up, which I can show you, and it got sold straight back down again. And that just tells you, that market, which obviously is very much impacted by the things like airline travel, shows you that economic activity is likely not coming back in a hurry. So, we got this brief pop here on OPEC, straight back to the lows, right? So, it's clear that the economic activity is going to remain weak. A lot of the data that we're getting out on the economy is disappointing to the downside. Things like retail sales, manufacturing data, stuff like that is all disappointing to the downside, and I'd expect that to continue. You've also got earnings season. So right now we've got the banks' earnings, which tend to be at the start of earnings season. They're all coming in, and if you look at the price action in the banks, banks' trading desks and trading floors are making money, but then they're losing money in other places, on loans and things like that. And basically in credit, in what's happening in the credit market, that's cost banks a lot of money. And then also they're taking massive reserves against further weakness that they expect to see. So this is giving the market an idea of the banks, who are kind of, at the forefront, who really can see where some of the weak spots are in the economy, and they're making major provisions, like JP Morgan are taking major provisions against that. So that just tells you that the outlook isn't as rosy as maybe the market or where the S&P is, for example, is kind of telling you. So that's kind of the fundamental outlook. Like I said, the virus issue, isn't done yet. You may well get further waves. If you look at how the US has kind of done their lockdown, it hasn't been as dramatic as a lot of places in Europe and certainly Asia. And that might mean that they don't return back to normal for a lot longer. All these hopes in the US that Trump has of getting the economy restarted in May, I can very quickly see that being pushed to June, July, as you start to see that the way they've handled this thing isn't that great. The bailouts, all this economic stimulus, the bailouts, they're still not getting to the people who need them. Yeah, I mean, whether it's the UK, Europe, US, all these bailouts that have been promised to help individuals and help businesses to stop them from going under, there just seems to be a lot of red tape to get through, and it's not getting to the people quickly enough, right? And it, by the sounds of it, it's not even big enough. Like, I know they've printed between all the major economies, we're talking about nearly 10 trillion. It wouldn't be surprising if they need to triple that number to actually stop this or stop the economic meltdown. So yeah, still unclear as to whether the stimulus is actually going to make any difference. All right, what about trades? How are we trading this thing? So, I had been generally buying puts on equity markets or every time we rallied. And S&P was predominantly where I was doing that. I'm starting to think there's definitely a chance that the S&P might just dislocate from the real economy and it might not really go down back to those lows. We may have seen the lows, okay? I mean, even though it doesn't rationally make sense that we've seen the lows, we may have seen the lows in equities for the US market, just because of what the Fed is doing and how desperate they are to hold it up. And also, if you think about what a large part of the US market, I mean, particularly the Nasdaq, is these mega cap tech stocks. And these mega cap tech stocks, you could argue they might be a bit recession proof. So if we look at what the Nasdaq's done, that has actually reached this Fibonacci retracement, the highest one. It's actually briefly gone through it. And if you look at some of the stocks that are in that index, some of the big tech stocks like Amazon and Netflix and things like that, they're actually at their highs on the year, which suggests that they have kind of become recession-proof stocks. Because what we're doing, we're all locked in our houses, we can't go anywhere. But if we need to buy any goods, we're using Amazon to buy them, right? And we've all got our Netflix subscriptions, or if we haven't, we're going and getting them, and we're entertaining ourselves at home. So these companies, these mega cap tech stocks, seem to have found a bit of a way to navigate through this recession better than most. And so I don't really want to be shorting equity markets that contain these stocks. I'd much rather short European equity markets like the DAX, like the Euro stocks, which basically, this chart's a bit messy. Let me see if I've got a cleaner one here. So what's the DAX? The DAX done? Yeah, so I mean, they all look pretty similar, but the DAX just hasn't managed to recover as much as the US market has, because it's got much more of the old economy stocks in it. It's got a lot of automakers, more industrial names in there. The Euro stocks as well, being exposed to the Italian market. It's got a bunch of Italian names in there. It's got oil. It's got some of the oil names in there, and we know that they're going to be negatively impacted by what the oil price is doing. So, the bounce has definitely been shallower in Europe. And, if you're confident that the real economy is going to deteriorate further, and you want to express that view in an equity short, then Europe is probably the place to be, because I feel like that's going to have less ability to insulate itself and dislocate from what's going on in the real world compared to, say, the S&P or particularly the Nasdaq. So, that's why I would suggest, if you're looking for places to short, you probably use the European markets to do that. And you could probably do the FTSE as well. We bring up the FTSE here. Similar sort of story, pretty shallow bounce in the FTSE. Obviously, it's got some of the major oil names in the FTSE, BP and Shell. So that's what I'd say. If you wanted to be relatively market neutral in equities, you could actually do a spread trade where you go short European equities and you actually buy the Nasdaq. So you run a relatively flat book, and you just play the deterioration of the real economy via that spread trade. That doesn't give you any outright market exposure, but if this theory and what's happened up till now, where the Nasdaq has recovered much more aggressively and left Europe behind, if that story continues to play out over the coming months, then that spread trade should make some reasonable money. So that's one way of trading the equity story. I also think gold. We talked about gold last time. That's definitely behaving itself, right? So all this money printing that's been going on, which clearly helped the equities bounce, has also triggered the next leg higher in gold. So if we look at the gold chart, obviously it had that sell-off along with equities, and it's recovered nicely, and it's taken out the highs. So, the sort of targets that I'm looking for in gold over the next few months are certainly 1900, maybe even close to 2000, would be a realistic target in my mind for where gold's headed. The fundamentals for gold never look better. The money printing that's going on across the globe basically is just debasement of fiat currency. People need to be allocating some of their portfolios into gold if they haven't done already. And in theory, there's a lot of assets under management out there that could still move towards gold. So there is still a shift that needs to happen, and that could fuel this sort of breakout that's happening in gold. And like I said, it's nice to have a trade on where the technicals make sense, the price action makes sense, and then the Fed are actually helping you with what they're doing, right? The Fed are going to keep printing money. They're going to keep plugging the hole, and that's just going to keep pushing gold, in theory, higher, because it's going to keep debasing the value of the dollar, and all the other currencies will also follow suit. So that trade, well and truly intact. The dollar trade, we talked about the dollar acting as a bit of a safe haven, and I expected that to continue. That's experiencing a bit of volatility. So we were breaking out up here. We're looking like we're breaking out at 103. We had a bit of a pullback, and now we've kind of been chopping around. The announcement of the stimulus in the US was probably the trigger for that later sort of pullback in the dollar. But if the DXY kind of holds above this 98 level, which it seems to be doing for now, then I would expect the dollar to keep going back higher. Where there is that global dollar shortage that we've talked about across emerging markets. It is the world reserve currency still, despite the amount of money that's being printed. It's hanging in there, and I think Europe potentially is going to come across a bunch of problems with what's going on with Italy. If you look at Italian bond yields, they're not signaling a pretty sort of scenario in Italy. So you could start to see more sort of breakup talks in Europe, which isn't going to be good for the euro, which is going to make this DXY go back to those highs. So I'm still long DXY, and I intend to stay that way as long as it stays above this 98 level. If it breaks back below this 98 level here, then yeah, I might throw in the towel on that trade, because it's not behaving the way that makes sense. Like I say, in these markets, I think a combination of fundamental views and technical views makes sense, but you just need to not be stubborn. And if an asset is behaving in a way that doesn't make sense with what the fundamentals are doing, then at some point you just need to not trade that asset, right? You're much better off in this environment trading assets that are doing what they're supposed to do based on the news flow. Whereas if you see a piece of news flow that should be dollar positive or should be dollar negative, and the dollar does something completely different, and I'm just using the dollar as an example of the asset, then maybe you shouldn't be trading the dollar, because there's forces that are driving that you don't really understand. So it's best to step out of that market. Right? So that's what I would say. So yeah, that's my quick market summary. Nothing really changed. Still bearish of the economy, still bullish gold, still bullish dollar. Equity-wise, generally bearish, but could see a situation where the US market doesn't sell off as much as it should. So the safer place to be short seems to be in Europe. So if whether you're shorting futures or buying puts, I would suggest doing it in DAX or Euro stocks. That's certainly what I'm looking at now. One last thing, obviously we're all locked down for God knows how long. I mean, the way things are looking, I'll be surprised if we're allowed to go back to work before the start of June. So whilst during lockdown, I am offering Zoom classes to students who want to learn more about using options and kind of understanding options. So the class is called Intro to Options. So it'll be Zoom classes of up to, say, 5 students at a time, a series of 1 hour sessions, maybe 4 hours in total. And there you'll learn about the basics of options, you'll learn about the Greeks, you'll learn about kind of practical using options to kind of trade and how to monetize it. Just an intuitive understanding and an intro to options, basically, that hopefully will help you whilst you're in lockdown to kind of learn to trade the market and understand how to manage your risk in these crazy volatile times. Right? So if you're interested in that, check out my website. It's going to have some links there for you to register. And then once I get enough students who are interested, then I'll start putting out some emails and scheduling some sessions. Right. Anyway, thanks for watching this. I hope the summary was useful. And as always, stay safe. Thanks.